Greetings, everyone, and welcome to our August 2024 quarterly macro and markets update with our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Deputy Chief Investment Officer at Beacon Pointe, and it is my pleasure to be your macro and markets moderator today. We've got a lot to cover, but before we bring Michael in, just a couple of housekeeping items. So we budgeted up to 90 minutes for this webinar, and we have more than 70 slides to cover. We do also get a lot of great questions from our audience, and we want to make sure that we have time for Michael to address as many as possible. So if you have a question and you haven't sent one yet, please type it into the Q&A box at the bottom of the Zoom screen, and then we will address it throughout the course of the presentation. Also, note that we are making a recording of the webinar available at beaconpointe.com/videos approximately 24 hours after the conclusion of today's live event. Okay, so what's on the agenda for today's call? In the first section, Michael will talk about the global growth outlook. In the next section, we will review current events, specifically the recent spike in volatility, deleveraging, and the yen carry trade. In the third section, we will discuss the economy, inflation, and the Fed. In the next section, we will talk about politics and the upcoming election. Markets have largely taken with calm the dramatic events of July in the presidential race. But does the election matter for markets? We'll try to answer that. And as usual, we will wrap up the webinar on how to position portfolios. The US economy appears to be slowing. Are we still on track for a soft landing? Okay, so without further ado, let's bring Michael in.
Great, thanks, Julian, very much. Appreciate it. We do have a packed agenda today. Again, be sure to get your questions in the Q&A. And thank you, everyone, for joining the webinar today. So I'm going to start by suggesting that there's a few very important things that we need to know as investors when we're trying to position portfolios for downside protection and, frankly, for return enhancement. We're pretty strategic when it comes to positioning portfolios, but there are things that can be done as markets provide opportunities for both protecting portfolios and generating additional alpha. What is it that we need to know? We need to know about the economy, where we are in the business cycle, what are the inflation dynamics, and very inextricably linked to the economy is the outlook for corporate profits. So if you know what's going on in the business cycle and you know what the Fed's going to do about inflation and the economy, and you can make some judgments about where we are in the corporate profit cycle, that's all you need to know. There's a lot of things that aren't on this list, and we'll talk about those in a second. So what is the economic outlook? I like to start the webinars with a conclusion. And the answer is, are we going to have a no landing, a soft landing, or a recession? And the answer is, a week ago, it looked like we were heading straight into a recession, but that didn't last very long. And there are no signs, no strong signs yet that we are in a recession. We could be, we won't know for weeks, but signs are pointing to more of a soft landing right now, and we'll dig into that a little bit. There's no signs of recession on the horizon, although the labor market does seem to be weakening a bit. What about the Fed? Well, the inflation is going to allow the Fed to cut rates in September. It's almost guaranteed that they'll cut at least once, and the market is actually pricing in more than one rate cut in September. I don't think that'll happen. I think that would signal maybe some distress or concerns that don't exist. There was actually talk of an emergency rate cut last weekend, not 3 days ago, 2 days ago, but 10 days ago after the labor market report. And as the yen carry trade started to unwind and you saw volatility spiking in equity markets, which, by the way, we're going to dig into pretty deeply in the first section. But as it stands right now, the Fed is on track to lower rates in September, and for the remainder of 2024, lower rates 2 to 3 times. So that's our view right now. What about corporate profits? If we don't get a recession, they appear to be resilient. So all of these things remain constructive for markets. It's not to say something challenging couldn't happen, especially during an election year. You tend to see an increase in volatility. We certainly saw that last week, beginning of last week, but none of the signs are pointing to anything severe just yet. So it's the answers to these questions. Where are you in the business cycle? what are the inflation dynamics and what's happening with corporate profits that you need to know to position portfolios, and that's what we're going to dig into. Those are the only things you need to know. What's not on that list? Politics, elections, what's going on CNBC, what Jim Cramer's saying, stuff like that. None of that really matters for your longer term investment goals, and assuming you have a financial plan. We're going to build a portfolio that's going to get you where you want to go over the long run. It's an all-weather type of an approach. It's not something that takes into consideration short-term vol drivers like an election. So let's dig into that. Let's see. Again, starting with the conclusion, how are the portfolios positioned? We're still neutral risk overall. We have been for 7 quarters straight now. Both equity risk and bond market risk has now been adjusted slightly to both be neutral. We were a little underweight equity risk and a little overweight bond market risk 90 days ago, but no longer. Like large cap value, like that over growth. We think the large caps will outperform small and mid and international now, and we're neutral interest rate risk. But finally, and always, we're going to have a strategic allocation to alternative investments with strategic weights in private equity, private real estate, private credit, real assets, and hedge funds. Right now, we're still in a very uncertain economic environment. While I'm highly confident the Fed's going to lower interest rates in September, it's not a guarantee. So given the level of uncertainty, and again, heading into the home stretch of the election, it's best to be neutral risk, not no risk. Neutral risk doesn't mean no risk. Neutral risk means the risk that your strategic weights indicate that you should be taking to achieve your investment objective. So stay close to home. Don't take any excessive risks over the coming months. Julian, is there a question?
Yeah, I think it's a great time to actually address the first question that was put to us on the chat, which is about what percentage of a portfolio should you have in alternative investments. So we're promoting alternative investment, but what percentage is right?
Oh, it's a very good question. I would say talk to your institutional consultant or your private wealth management advisor to determine what that level should be. But for institutions, the number is between 20 and 40%. For individuals, the number is between 10 and 30. Could be anywhere in between. We've selected for a 70-30 growth strategy a number of 22%. That tends to balance the distinct advantages of alternatives, which are higher risk premium and higher return potential with the liquidity constraints that some folks feel. You don't have as much liquidity constraint as you think. Most people feel much more comfortable with 100% liquidity and they don't like locking up their money, but you get paid very handsomely for locking up your money. So 20% plus or minus for individuals, 30% plus or minus for institutions seems to work. I hope that helps. Anything else, Julian, before I dive into global growth?
No, I guess we have 5 long sections to review. So let's get ahead with the first one.
Yeah, I agree. So we always look at the purchasing manager indices from JP Morgan. The orange line here is the Global Services Purchasing Manager Index. Whenever it's above 50, it's a diffusion index. So it's above 50, it's in expansion mode. If it's below 50, it's in contraction mode. And both manufacturing and services are above 50, although they do seem to be losing a little bit of steam here. But the important thing to note is global growth is strong. It's good. The activity indicators indicate that there's really no problem. And if you look at global growth overall, I mean, most of the numbers are green here. We may have seen a bit of a peak in May and June of 2024. We'll need a couple more months to determine. But in terms of global growth, things look okay. Developed markets are actually in slightly better shape than perhaps EM, but global activity is expanding. Maybe a little bit, well, certainly more so than 6 months ago, but maybe things seem to be losing momentum here a bit. What are the central banks doing around the world? Well, there's a lot more cuts than hikes in the past 3 months. Emerging markets is the orange bar here. This is the last 3 months. This is the last year. And this is emerging market average central bank rate and developed market average central bank rate. Note there's 2 different scales here. You've got the emerging markets over here on the left-hand scale. So the average emerging market central bank interest rate's about 9%, but it's down about 35 basis points from the peak 6 months ago. Same with developed markets. Developed market central bank rates are coming down. So we have seen the end of the rate hike cycle, and we're well into rate cutting cycle. Again, in the last 3 months, you only had 3 total rate hikes, where you had 28 total rate cuts across emerging and developed. And that is just indicative of the fact that central banks and are concerned about slowing economic growth in some of the economies. Again, we saw that on the prior chart, that things seem to be rolling over a little bit. So it's not surprising that we're seeing central banks attempt to support economic growth with interest rate cuts. Let's dig right in, because I think a lot of people were concerned and maybe didn't fully understand what happened at the beginning of last week, and maybe were concerned that it was going to be the start of a deeper equity downturn, or maybe even an equity bear market. But I want to describe best I can in the next 5 or 10 minutes what the yen carry trade was all about. So it's just a leverage. It's a way to borrow cheaply and to invest in riskier assets, which for many folks they've thought was guaranteed profits. For the last couple of decades, interest rates in Japan have been exceedingly low, zero, below zero, but certainly not above 50 basis points at any time in the last 20 years. And as a result, that caused the yen, particularly in the last 9 months, to slowly depreciate as U.S. interest rates rose. That is, you got to think about like interest rate differentials, and we're gonna see a couple charts on this, so it's important to understand what I'm talking about. As U.S. interest rates rose and Japanese interest rates were expected to remain the same, that causes the yen to depreciate, because the dollar looks more attractive with higher interest rates here in the United States versus the lower interest rates. On the other hand, if you're looking to borrow money and invest in riskier assets, which is what the yen carry trade is all about, low interest rates in Japan became even more attractive on a relative basis as the U.S. began raising interest rates 2 years ago. So very low interest rates in Japan made it advantageous to borrow or sell short the yen to buy risky assets in other markets with those proceeds. And again, a lot of hedge funds were thinking, okay, we're going to make guaranteed profits doing this. Of course, nothing's guaranteed. And that is certainly what was happening during this first half of 2024, during this period of leveraging. Well, August 2024 came and you saw the deleveraging. This is the flip side. Interest rate differentials between Japan and the US compressed. That is, there was an interest rate hike, modest, in Japan, but the outlook for US interest rates also was exceedingly lower in July, at the end of July, the 31st, 1st of August, 2nd of August. We got the labor market report on August 2nd. All of those things contributed to an expectation that US interest rates would come down at the same time Japanese interest rates were going up. This interest rate compression caused the yen to appreciate dramatically. And when the yen appreciated, all these yen shorts, the folks that had borrowed money in yen, started to receive margin calls. So they had to force sell riskier assets to meet their margin call with their yen lenders, which caused all sorts of risky trades to sell off, many of them pretty violently. So it was the unwind of the yen carry trade. It's just another example of how leverage in the system can exacerbate price moves, particularly in August when there's not a lot of traders around. So we're going to dig into a couple of more slides here to see if we can understand this better. Julian, do you have a question?
Yeah, I guess maybe you can explain a little bit what the SAM rule is, and how I think she even, like the person who created it, just came out with a column to say that this time it may not, the rule may have been broken. It doesn't necessarily mean we're in a recession.
Yeah, Caroline Sam is a well-regarded economist. She produced a rule many years ago that suggests that if the unemployment rate goes above a certain level based on the last 12 months, if it rises 50 basis points over the most recent local low, then you've historically always been in a recession. Now, her rule works great in the United States and has called every post-World War II recession. So a lot of folks are looking at it. As of a week ago Friday, that's August 2nd, when we got the labor market report, the unemployment rate bumped up to 4.3%, and that triggered the SAM rule. So we'll see what it means later in the presentation. But even SAM herself came out and said, there's a lot of things different about this recovery. There's interactions with labor force participation rates and structural changes in the economy. she basically said, we're not in a recession. I don't know. She might be getting a little ahead of herself. We might be in a recession. And if the unemployment rate continues to rise, we will be in a recession, regardless of participation. Well, not regardless, but it's not expected that participation rates would bail you out of a recession by rising at the same time, and causing the unemployment rate to rise. More people looking, for work. The unemployment rate's the interaction of a couple of things: people that are working and people that are looking for work. So I would just say the SOM rule, I think, has been useful. We've talked a lot about it during our investment committee, and having the inventor of the SOM rule come out and say maybe it doesn't work this time. I don't know what to think about that exactly. I think it's one input, one signal that you can look at and say, well, things are slowing in the U.S. economy, but maybe not into recession territory. We'll talk more about that in coming sections. But let me go back to the yen carry trade for a second, see if we can clear a few slides here and get a better understanding of what exactly happened beginning of last week. Let's look at this slide. This is Fed funds and the Bank of Japan's policy rate. The Bank of Japan, this goes back 2 decades. Bank of Japan policy rate, again, never been above 50 bips. In the last 20 years, although we did get 2 rate hikes, one 20 bips, one 15 bips. So it went from -10 to +25 basis points. Literally, the Japanese policy rate since 2015 was -10 basis points. So now we get these 2 relatively small, but pretty big if you're thinking this is going to last forever, rate increases, while at the same time, the Fed seems kind of to be on hold. A lot of things happen. But let's just take a look at this. You had over on the right, what you can see during the same time period, the interest rate differential, by the way, is the green line. Every time, the Fed rate, the Fed funds is higher than the Japanese policy rate, which is most of this period. Here, they're, almost the same from the Great Financial Crisis to 2015. They're about the same. So you can see, that's this period here. But there's not, when there is a difference and when the Fed is hiking, and the Japanese Bank of Japan's not, then this green line goes up. And when interest rates increase versus Japan, you tend to see a yen depreciation. So what we saw here that accelerated in 2022 to 2024 is this yen depreciation as the Fed funds rate rose dramatically and the Japanese kept their rates right where they were supposed to be. So you had this pretty meaningful appreciation in the yen. So it's really the interest rate differentials that matter for currency relative val. Higher rates in one country means that it's likely that country is going to see some appreciation. Julian.
Is the unwinding of the trade done? Are we?
Let me finish this because the answer to that question is unknowable, but JP Morgan thinks it's 2/3 or 3/4 of the way done. This is one indicator, though, that could indicate whether we're done. This is the CME or Chicago Mercantile Exchange yen currency net futures. So these are net long yen positions before August of 2021. And then since August of 2021, you've had significant net currency shorts. So you had almost 190,000 short contracts at 12.5 million yen each contract. In this period from August 2023 to August 2024, this massive increase in yen shorts. So this, where are we now? We went from minus 190,000 to minus 11. So a lot of people have covered their short position. So that's, I think, probably part of where JP Morgan says we're 3/4 of the way done, because we've a lot of this short position is unwound. While at the same time, by the way, this August 2023 to August, the last 12-month period where you had this accelerating yen short position, not surprisingly, when you can borrow money, this is the Nikkei stock index. So this is the S&P 500 of Japan. During the same period, it rose to a 34-year high by the middle of July at 42,000, the highest we've seen since the early 90s, actually late 80s, I guess. And that all, unfortunately, when the reversal came, when the number of yen short positions here started to decline, that is, people started to get long the yen, were unwinding these bets, you had to sell something, and a lot of folks sold the Nikkei, which was down 20% almost 20% in 2 trading days, and 25% from the peak on July 11. It's subsequently recovered somewhat, up 11%. Again, so high volatility, but just let me see if I can summarize what's happening here. When you have all of these yen short positions, that's indicative of borrowing, and the borrowing went into something, and generally that something was risky assets, things like the Nikkei, Bitcoin, Nvidia, investment grade corporate bonds, et cetera. So what happened to some of these other markets, I'll show you in a second. But there's another thing that occurred that I think is of interest and might be somewhat comforting to the folks on the call when thinking about equity market volatility. So the equity market volatility index, or the VIX, which is also known as the fear gauge, peaked in 2020. This is March of 2020. This is back in COVID. So this is the VIX index from February to May 2020. And again, the VIX index in August of 2024. It's just a representation, again, of annualized equity market volatility that when it rises, it means that there's a lot of fear in the marketplace. So there was a ton of fear back in March of 2020, and you saw the VIX index peak at 85. And for 2 months afterwards, the average subsequent to the peak was almost 45% annualized vol in February and May of 2020. Here's what happened last week. So you had July 31st, vol was very low. Intraday, it peaked at 65.7. So uncomfortably close to the peak we saw in COVID. But what happened next was completely different. Instead of this low, slow grind lower back to the 30s, the VIX went from 65 back down to something on the order of 25 in 2 or 3 trading days. And the average of the last 6 days is close to 26. And now we're at 19.5 on the VIX. So equity market volatility dropped very quickly. This is some evidence to suggest that what was going on in the equity market was an unwind of a levered carry trade and a technical selling issue, as opposed to something fundamentally wrong with the U.S. equity market. Julian.
So what happened last Monday and all this, does it really matter if you're a long-term investor?
No, it doesn't. I mean, here's the risk is that the yen carry trade unwind, which is just another example of a deleveraging of one, investor cohort that was borrowing money to invest in risky assets that got caught in a margin call. That's, by the way, that describes almost every financial disaster of the last 800 years. Just use the word leverage and you pretty much capture all of it. So how much leverage remains in the system? Going back to your original question, Julian, about how far through the unwind of the yen carry trade are we? The answer is we're pretty far through it. And the banking system is highly, highly capitalized, especially versus 2008. So the same kind of exogenous shocks or financial shocks, whether it's a currency shock, an equity market shock, a credit market shock, these are the things that tend to start a panic, because one thing, a domino falls in one part of the world, and then it starts to affect capital levels in banks and in the financial system, or outside the financial system, which is what happened in 2008. You didn't know how over levered. Well, you kind of knew, because most of the banks, Lehman Brothers, Bear Stearns, they were all over levered. They just didn't have enough capital. So they failed. And when they failed, another domino or number of dominoes fell. I wouldn't be surprised if we hear of a hedge fund that got blown up because of this in the next couple of weeks. Because this is the kind of thing where, individuals, hedge fund operators who tend to get over their skis may have not used proper risk controls and may get taken out. But it doesn't appear yet. No prime broker, no Goldman Sachs hasn't raised their hand. Pershing, nobody's raised their hand and said, we have a problem with this hedge fund because of the unwind of the yen carry trade, at least not yet. But again, I wouldn't be surprised if you did hear that. Here's another reason for to feel okay about what happened last week, and to think it was more technical technical deleveraging rather than some fundamental problem in the markets. On the left, you've got U.S. investment grade corporate spreads, and on the right, you've got U.S. high yield spreads in July and August of this year. So the spreads are compensation for risk taking. When the spreads spike upward, it means there's the market is telling you it's providing more compensation for default risk. It's basically a sell-off kind of an environment. So the August 5th peak on investment grade corporate bond spreads was 111 basis points. The 20-year average is 40 basis points higher than that. It's right on the 5-year average, this peak during the worst of it, and we're back down to 103 basis points. So credit markets really didn't see that the equity market volatility was fundamental, just more of a technical deleveraging. Same for high yield spreads. You had high yield spreads peak at 380 basis points, but the 20-year average is 100 basis points higher. We're still below the 5-year average on US high yield spreads. These numbers actually blew out. Like this number was 600 basis points during the great financial crisis. A lot of very well respected banks were trading at 500 or 600 basis points over treasuries, which is just another way of saying they had a very high probability of defaulting, but not now. This is indicative of a credit market. At least credit investors, corporate bond investors, aren't thinking that would happen in the equity markets last week was that impactful. A couple other markets, you've got NVIDIA stock, Bitcoin, and again, investment grade corporate bond spreads. This is the rally in NVIDIA from 40 to 135, and then the sell-off from 135 all the way down to 99, but then it's recovered. NVIDIA's recovered to 109 basis points. Bitcoin was at 73,000 earlier this year, 68 right before the unwind. It dropped to 54,000 per Bitcoin, and now in the ensuing modest rally, gone to 58. And then you've got investment grade corporate bond spreads, which rallied dramatically, indicating there was a lot of maybe borrowed money out there investing in NVIDIA, Bitcoin, and IG corporates that went away. But again, the magnitude of these moves was gut-wrenching at the time, minus 30% on NVIDIA stock, minus 15 or 20% in Bitcoin, and then this massive, kind of a massive sell-off from 89 basis points to 111. I mean, it's just, I'm making a joke. It's just not, things seem to have settled down pretty meaningfully. It doesn't mean we can't have a repeat if there's another leverage trade out there that we're not aware of that has to be unwound, but this trade doesn't seem to have caused any fundamental damage. Julian?
I just want to ask a question about NVIDIA, because I guess it will probably help people understand how we think about asset allocation. Basically, the question is, do you consider NVIDIA risky?
Do I consider it risky?
I mean, and I guess taken in isolation.
Yeah, if you only own NVIDIA, I would consider that risky. We're not an equity analyst, but I do follow some of these mega cap tech stocks, and I would say, the fundamental valuation of a stock hasn't changed. It's just the uncertainty around corporate profits and whether or not revenues and profits can keep up with the price that folks are projecting into the future. The stock price of NVIDIA, like any other stock, is just an estimate of its future cash flows based on corporate profits, 10, 15 years into the future. So is NVIDIA risky? I measure risk by volatility, and NVIDIA is pretty volatile. Bitcoin is volatile. US investment grade corporates, not so volatile. But so I measure risk by volatility, and by that measure, and again, in a diversified portfolio, NVIDIA is not risky. In a diversified portfolio, you can add what are apparently risky assets to a portfolio and actually improve its risk-adjusted returns, as long as they're not perfectly correlated. So no, in a vacuum, NVIDIA is risky. In a portfolio at not egregious, allocation levels, something less than a few percent would be probably the max you'd want of your net worth in one stock, let alone a stock like NVIDIA. So you want to have a diversified portfolio, and that makes any risky asset a lot less risky. I want to make two more points on the yen carry trade. It's not so much interest rates today, it's the future of interest rates that matter for currency and foreign exchange. So what are we looking at here? This is 1 year forward US rates versus 1 year forward Japanese rates. So again, US rates are much higher than Japanese rates, and looking over the next year or so, at the end of or the middle of July, it was anticipated that US rates would be almost 3.5 percentage points above Japanese rates. But then you had this repricing of the Federal Reserve, and you had this concern that Japan was going to have to raise interest rates, Fed was going to have to cut interest rates a lot, and that number compressed by 80 basis points in 2 trading days. It's unbelievable. Again, it's recovered, so it seems like it was a I don't know if you'd call it a one-off, but certainly not a systemic problem with positioning and leverage. Things seem to have calmed down pretty dramatically. But again, while you have this high differential where U.S. rates are much higher than Japanese rates, you're going to get a yen depreciation. And once you get this repricing where you see that, oh, the differentials aren't going to be as big, you get a massive yen appreciation. So you had a 10% rally in the yen after these rate expectations, these forward-looking rate expectations adjusted, and that's what caused the margin call. I just want to look at a couple of returns of equity market factors and indices year to date through the end of July. Factors are in orange, indices are in green. The S&P is here. So year to date through July 31st, the S&P was up 13%, and foreign stocks not so much. But in terms of the factors that were outperforming pretty dramatically, momentum, quality, GARP, these are the things that have done really well. This is year to date through end of July, and value was lagging. So not surprisingly, here's the value index. Here's the value U.S. value factor. Those are obviously not exactly the same. But from July 14th to August 5th, so in these 3 weeks of trading, you had a pretty amazing reversal as volatility spiked. Momentum, GARP, and quality got kind of hit, whereas the value factor or the value index tended to outperform what had underperformed. So a pretty big reversal. What worked for the first half didn't for these 3 weeks. But then looking at the same factors and indices from August 5th to today, what you have is a return to the first half trade, which momentum's outperformed. Again, this is from August 5th. This is 1 week of trading. Momentum factor is up 7%, quality is up 5%, and values up 2.4. I think if you have increasing volatility towards the end of the year, you'll probably have maybe outcomes that look maybe not this dramatic, but this would be the order that you might see in terms of outperformance. You'd like to see these numbers positive, but I don't, I can't say, but it looks like at least in the last week or so, we've gone back to what was working in the first half. That's the equity market. In terms of the bond market, before all this happened, 10-year yields were at 4.2%. And then you had on July 31st, the FOMC rate decision, which was last 2 weeks ago tomorrow, July 31st, Wednesday. The day after that is August 1st. You had weak economic data in terms of jobless claims, auto sales, and the ISM. And you had a week, this was the big one, the weak labor market report on Friday, August 2nd. And that took 10-year yields all the way from 420 down to 369. And up until yesterday, they're down a little bit lower here. But they rallied, not rallied, they sold off. But when interest rates go up, it means the price of treasury bonds is going down. So you've seen a bit of a sell-off. We're at, this is August 7th. As of the 13th, we're back to 385 plus or minus. So you had a, kind of a grind back. So nothing was, nothing kept going. Equity prices stabilized and recovered. Interest rates went down in a flight to quality trade and then stabilized and recovered. 10-year yields did this. This is from April, so this goes back four months now. Middle of April, you had a pretty nice rally, but it's this massive drop off from 450 on 2-year notes to 379, 428 on 10s to 373 that occurred through August 2nd when you had fears of recession. Before that, it was this tug of war between fears of recession and higher inflation, but inflation does seem to be under control. Bottom line, though, even with these lower levels, bonds still look attractive in a portfolio. Why? Because the real yield on bonds is very strongly positive. When you have high real yields, which is represented by the green here, the real yield on 10-year notes going back to post-COVID was actually negative. Bonds were absolutely not the place to be when the real yield's negative. They are the place to be when real yields are positive. So as of today, actually, this is August 13th, bonds 10-year yields at 386. 210 is your inflation expectations, but 176 on real yields is pretty attractive. Julian. Yeah,
before we go to the next section, maybe a quick one on explaining how you can invest in factors, or how, how does that work? How do we think about factors, basically?
Oh, well, I mean, all the risk models we use identify the factor exposures that we have in the portfolio. So while we tend to tilt cyclically based on value growth, large, small, US, non-US, et cetera, we're also quite aware of the exposure we have to things like momentum, quality, et cetera, minimum vol, because we calculate it, we measure it. Because ultimately value means one thing to one person and growth means one thing to another, but the factors are empirically determined. So that's what we use when we quantify the risks that we're taking in the portfolios. We do measure the over and underweights to large and small value growth, US, non-US, but we're also, when we're managing, we're actually building the portfolios, we're building the strategy portfolios that we use both for institutions and for private clients. We're also measuring the factor exposures. So you can tilt the factors by having, by looking through the portfolios and looking what our active managers are doing, or you can actually add ETFs that have specific value or growth, value factors or momentum factor or quality factor or minimum vol factor or dividend factors that can enhance the returns of the portfolio. Generally, we're doing that through our active managers, and we're not taking ETF exposures, but because we don't have to, because we're measuring it anyway, and we're trying to optimize the portfolio for our outlook. And right now, we're overweight value to growth, and we think that's going to be a good bet. We're neutral or a little bit overweight US versus non-US, and we're overweight large versus mid and small. And those are the factor and or index exposures, however you want to describe it, that are likely to do well in a higher volatility environment, which is what we expect in the next 3 to 6 months as we get through 2024. So before we talk about politics, I want to just have a couple of slides on debt sustainability because it's a hot topic. We do have a debt problem, but neither one of the candidates for president and none of the senior leadership in either the House or the Senate is talking about how to deal with the debt issue. If we don't get a handle on the debt, it's going to go from 120% of GDP, which is where it was after World War II, and climb inexorably higher to something close to 150% of debt to GDP by 2035. And on the current trends, the CBO doesn't project out more than 10 years, but if they did, it'd have us going to 200% debt to GDP, which is about Japanese levels and above what Greece was when they had their debt problems in 2011 and 2012. So this is not sustainable, and we're going to have to fix it. And there is only a couple of ways to do it. A couple of ways, some are painful, obviously painful, higher taxes or lower services expenditure. That is a fiscal adjustment where you're balancing the budget, or you can inflate your way out of it, which is kind of a financial repression thing. But we're going to have to do something. Total government debt's over 35 trillion. The interest cost that we're paying on each dollar of debt used to average about 1.5%. Now it's more than double. So that means the interest paid on the debt, which is a function of both the total debt and the interest that you're paying on it. So these are the dollars. By 2034, we're going to be paying $1.6 trillion on the debt. And by 2026, the debt costs will be higher than our defense costs. So it is definitely something we have to deal with. But again, you're not going to hear about it during the campaign. You're going to hear about it after the election and after the next Congress gets seated in January 20th of next year. Actually, Congress is January 4th or 5th. The president is inaugurated on the 20th. So you're going to, by January of next year, this is going to have to start to become top of mind, especially given in 2025, it's the most impactful year for taxes since the tax code was created in the 1913 plus or minus. Why is that? Because all the 4 trillion plus of tax cuts that were part of the Tax Cuts and Job Acts of 2017 are scheduled to sunset at the end of next year, end of 2025. So a lot of work needs to be done on fiscal policy. And the tax plans of both of the candidates are likely to become, we're going to hear more about it between now and November, but we're not going to hear about any solutions to fix this. Why? I mean, there's budget deficits for as long as, for as far as the eye can see. This is budget deficits going back 40 plus years. Last time we had a surplus in the budget was in the late 90s. So no surplus, just deficits and 6% deficits. It's pretty challenging to think about how to deal with it. Here's why it's going to be something that needs addressing. There's a measure here, and I presented this last time. This is the percent of tax revenue. So the government takes in tax revenues and then spends a certain percent on interest costs. And the interest costs of versus tax revenues used to be around 10%. It was below 10%. When it was below 10% from the late 90s until just recently, you can have more accommodative fiscal policy. You have more degrees of freedom. But once you get above this sort of this 14% threshold, it's commonly believed that you need to fix it. So you need to reduce your net interest costs by reducing the debt. That means balancing the budget or inflating away the real debt burden by having lower, higher inflation and lower budget deficits. But that's challenging too. So the next administration is going to be forced to deal with the debt because we're closer to 17% as of tax of interest costs as a percent of tax revenues. This highlights it. But don't worry, we're not going to have a crisis necessarily, because there is a debt sustainability equation that the IMF uses and that we used in one of my prior roles as global head of sovereign research to look at all countries based on their interest costs versus their growth. So this is just in the US going back 25 years, when growth was less than the interest rate paid on the debt, that puts you in a debt spiral. When growth is above, when GDP growth, nominal GDP growth is above the interest rate you're paying on debt, then you're going to be fine. You have a sustainable debt dynamics. But when it goes below, or if you have a spike in interest rates or you have a recession, then things get a little more dicey. So as long as we can continue to grow, and the forecast for growth is about where growth is almost 3% more than the nominal GDP is 3% greater than the interest rate expected interest rate we're going to pay on debt. At least it is as of the third quarter of 2024. Going forward, it's closer to like, I don't know, 50 or 100 basis points, call it. But that's all you need. As long as GDP growth is higher than the interest rate you're paying on debt, you're not going to have a debt crisis. Julian, question?
Yeah, and clients are worried about the sustainability of the dollar as a reserve currency and what we would mean if there was a collapse in the dollar, and how you position your portfolio for that.
You don't need to, because a collapse in the US dollar requires that some other currency is going to take on the role of a reserve currency, and there isn't one. So you can safely ignore the doomsayers who are saying the dollar's going to have a crisis. Tell me what will replace it. I assure you it won't be gold. Gold is too hard to lug around. I assure you it won't be Bitcoin. Bitcoin is way too volatile. It will not be the euro, because the ECB and the European zone, the Eurozone growth metrics don't argue for it. 25 or 30 years from now, it might be a foreign currency. In the next 5 or 10 years, there's absolutely no chance whatsoever of a currency crisis in the US, where the US dollar is no longer viewed as a medium of exchange and a store of value and the world's reserve currency. So a lot of the things you're going to hear again from folks that call them the doomsayers, they're trying to sell you a newsletter, they're trying to sell you gold. So just kind of put it aside and realize what the bias is there, and then take a look at this chart and realize that the only time you have a debt crisis is when you can't grow your way out or inflate your way out. And again, this is nominal GDP over the interest rate we're paying on debt. So, you could say it's a bit of a circular argument. As long as we're the reserve currency, we can have lower interest rates, which is true. But until another currency presents itself as a plausible substitute for the US dollar, I'm not going to give that much concern, because the probability is vanishingly low that something bad happens to the dollar in the next 5 or 10 years. It's a good question to ask, but it's not an imminent threat to the portfolios. So don't do anything based on a view that the dollar is going to not be the reserve currency, because it is. It will be. There's no credible thesis that says X will replace the dollar. I hope that helps. That's one thing there's not a lot of things that are certain in investing, but we've had 10 reserve currencies in the last 1,000 years, going back to the Spanish peseta, the Dutch guilder, the UK pound, and the US dollar, all the way back to Roman times. So the transition from one reserve currency to another is pretty well understood, and we're not anywhere near close what happened to the end of the empire and the transition from the pound sterling to the US dollar post World War II. It's just not out there. We're going to jump right through a bunch of slides now so we can get to politics. I think that's probably what everyone wants to talk about. I always present the financial conditions indices. It's how the Fed manages the economy. They tighten financial conditions when they want to fight inflation, and they loosen financial conditions, which is their next move, when they want to support the economy. Financial conditions tighten massively on August 5th. So you can see this, it's financial conditions are sort of volatile, but this is a pretty big move, and it was related to the move in stocks, offset by a lower 10-year yield. But it's recovered. Again, seems technical and not fundamental, and it wasn't long lasting. Financial conditions have to tighten meaningfully and stay tight for a period of time to have an impact on the U.S. economy. So I wasn't thinking this was going to be the start of something bad, because financial conditions have since recovered. The stock market's broadly recovered. It's recovering today again. Interest rates are low. Spreads are not wide. Things are okay. Strong second quarter GDP, and the outlook for GDP for the next 5 quarters is Goldilocks. I mean, there's just doesn't 2.8 for the second quarter. That's the advanced read. We just got that a couple of weeks ago. We'll get another update on second quarter GDP in 2 weeks' time. GDP has been resilient, and it looks like a soft landing. How does it look like a soft landing? Here's GDP. Here's PCE, or inflation. And here's a nice, gentle stair-step down normalization of interest rates. This is the Fed funds forecast. These are all blue chip forecasts for the economy. 1 to 2% for the next year, 2 to 2.5% plus or minus for inflation, and the Fed funds rate going from 5.5 down to 4. So 4 rate cuts, maybe 5 rate cuts between now and June would be the blue chip forecast. We just don't know where normalization is. That is the landing strip for interest rates 4%, or is it 2.5? If it's 4, then we're pretty much done by this time next year. So no signs of stagflation, no signs of a recession. Did you have a question, Julian?
Yeah, is the market Fed pricing right, or is he doing the same mistake that he was doing at the beginning of the year, which to price too many cuts?
It's pricing too many cuts, probably, because fear and greed works in interest rate markets just like it does in the equity market. And right now there's the fear of a recession. We tripped the SOM rule that we talked about. Whether or not that's an indicator of a recession or no, I don't know. But if this is the outcome, then the blue chip economists have it right, then the stock market, or the federal funds futures market, and the outlook for Fed rate cuts is too aggressive. Because right now we'll see a slide, it's 100% that will get 4 rate cuts. The markets are telling you that the Fed will cut rates 4 times. I'd be very surprised if they cut rates 50 basis points in September. They could. That's what the market's pricing is: 2 rate cuts in 1 on September 18th, and then another rate cut in November and another rate cut in December. I think that's probably aggressive. I think we'll get 2 or 3, not 4. Not a meaningful difference, by the way, but enough that unless we get a recession. But right now, the probability of a recession, if it looks like we're going to get a recession, a couple of things will happen between now, and it's between now and election day, or at least between now and the time before most people vote. It'll probably affect the election, and it will cause the Fed to lower interest rates faster. They're going to do it based on the data, not based on the election. So separate those two. The only candidate that wants to interfere with how the Fed operates, is the Republican candidate for president, he's made several remarks in the last 2 weeks that are a little disturbing to those of us who spent our careers following an independent Federal Reserve Bank. It's not right. It would be, most economists think it would be disastrous if the Federal Reserve was politicized, and I tend to agree with them. But as it stands right now, there's a 30% chance of a recession. That's from the peak. 18 months ago, it looked like 2/3, chance. And it looks like maybe third quarter GDP is going to come in closer to, above 2.8, around 2.9. This is the Atlanta GDP Now forecast. It pretty much hugs the actual GDP number and gives you a running look at it. And the GDP here versus is green again. And this is the city surprise index and the 3-month or the 1-month moving average of the city surprise index. Things are slowing. That is, economic data is coming in slightly, on average, slightly lower than the survey data, but nothing to be terribly concerned about here with these numbers. The economy's just been really incredibly resilient. Labor market's pretty strong, maybe weakening, and the consumer has been in good shape so far. We like to look at inventory to sales ratios, leading economic indicators, the financial conditions indices that we talked about before, which are comprised of market data, and then sentiment indicators. And frankly, as of the end of June, everything looked pretty good. Everything looked pretty good, and so there's nothing. Leading credit indicator is the only one that's red. That means banks are tightening financial lending conditions a little bit, but nothing to be concerned about. So we're probably, still in this kind of trophy area, but the way we've described it is, well, maybe that trough isn't really a recession. Maybe the trough is kind of a, maybe we're here kind of heading for, a bit of a soft landing or slowdown. Whether we're kind of here or here, are we going to start to see an uptick? I don't think so. I think we're probably closer to maybe a little to the left of here and heading for a trough, but maybe not a recession. But here's the number that got everybody spooked 2 weeks ago, and that is the non-farm payroll. So it's 114 new jobs, which was 175 was the survey, and the prior was almost double what we got. But that's not a scary number per se. The scary number might be unemployment at 4.3, up from 4.1. But the Fed really cares about this number, average hourly earnings. So while the labor market is slowing, not surprisingly, average hourly earnings is also coming down, and this is what the Fed cares about. So, this number here was the lowest number. There was one other number, I think it was 108,000 jobs added, but in the last 6 months. But prior to that, this is the lowest number since 2020, plus or minus. So that's what got everybody spooked, caused the interest rate market here in the United States to price a lot of Fed rate cuts, and that combined with the July 31st Bank of Japan rate hike is what's triggered all of the yen carry trade nonsense. So here's the SOM rule. So we talked about it at the beginning. Whenever, the SOM rule basically says that it signals the start of a recession when the 3-month moving average of the unemployment rate rises by 50 basis points above the low of the last 12 months. So this is the SOM rule indicator. It did breach this 0.5, but not, meaningfully. And again, SOM herself's not quite sure if this time is different. So again, concerning having only 114 jobs. So here's the 108. It was back in April, but prior to that, you got to go back 2 or 3 years to see a number this low. And so the 3-month moving average is coming down pretty meaningfully. We're at 168,000 new jobs. So this is well below the 3-month moving average. So it's, the labor market does look like it's slowing. Is it cracking in half? No. Is it a disaster? Absolutely not. But it's definitely slowing. And the consumer is struggling a bit. So the consumer is now seeing delinquency rates rise on consumer loans and credit cards. But these are the great financial crisis levels. Here's where we are now. So the red is the danger zone. Yellow is just caution. It's this move up, though, that is concerning. If it stabilizes at these levels, then we'll be back to the sort of the 20-year average. But if it continues higher and the consumer is unable to, and it will go higher as the unemployment rate rises. If you don't have a job, you can't pay your credit card. If you can't pay your credit card, the default rates go up. So that's what we're keeping an eye on. We did get some good inflation data this morning with the PPI. We're getting CPI tomorrow. So one of the most important data releases for the Fed to determine what they're going to do in September comes tomorrow. But as an intermediate inflation measure, CPI is a final inflation, but intermediate means it's it's intermediate goods. So producer price index showed very positive numbers. So 1/10 month over month versus 2/10 on the survey, and year over year 2.2%. That's right in line with the Fed's target. They don't target PPI, they target core PCE, but that's a pretty good number, and it's lower than the survey. So that caused Fed rate cut probabilities to increase, because when traders see the producer price index coming in below survey, and the next day you always get the CPI, and the next day, then the outlook for the CPI looks a little more positive. Here's CPI. We're gonna get a release. CPI tomorrow. CPI core headline peaked at 9.1. Core CPI at 6.6, and those two numbers are closer to 3 now, and they seem to be on the right trajectory. I look at super core. That's what Jay Powell looks at. So this is a PCE core here, and then you have Jay Powell's favorite inflation measure, super core. PCE core here is year over year, it's 2.5%. That's already a good number, but the momentum is even better. The last 3-month moving average, or the last 3-month average of PCE core, which is the Fed's preferred target measure, is much lower. It's not half, but close of the year over year number, and that tells you that the next year over year number is likely to be lower than 2.5. That's within striking distance of the Fed's goal. So that's why the Fed is going to have some room to deliver a rate cut, probably of 25 basis points in 5 weeks. Now for Supercore also looks it's a little more volatile. Supercore is more volatile, but the momentum is even stronger to the downside. So you have 4.5% year over year on Supercore, but the 3-month average is much lower at 23 basis points. So momentum is good, and this is causing Fed rate cut probabilities to increase. Here are the Fed rate cut probabilities for September: 100% for a 25 basis point rate cut. Last week, this was almost 100% for a 50 basis point rate cut. By November, we should have 2 rate cuts. So orange is 50 basis points of cuts. Gray is 75. There's a pretty good chance by November, the market's telling you we could have 3 rate cuts. And then by the end of the year, there's a 100% chance of 4 rate cuts. It priced into the market. I think that seems a little aggressive. So 100% chance, the market's telling you 100% chance of a 25 basis point rate cut, and a little more than half, 50% chance of 2 rate cuts at the same meeting. So 50 basis points in September. This number again was over 100% during last week's yen carry trade ruction. So what are we thinking? I mean, I think the economy is going to slow to 1%. It may not go to 0, but I think the economy will slow more than the blue chip forecasters are thinking, because that's an average. So there are folks that are at 0, and there's some folks at 2, and that gets you to 1. I think it's below 1. That'll allow inflation to continue to resume its downward trend, and the Fed will cut rates 2 to 3 times. So stagflation is a tail risk. I wouldn't rule out a soft landing. I wouldn't rule out a recession. Those 2 things are the most likely outcomes, but not a deep recession. There doesn't seem to be enough imbalances in the market, imbalances in the economy. You don't see a lot of leverage. The housing market's not overbuilt. In fact, it's underbuilt. So there's a lot of things to recommend a soft landing this time, or if we do get a slowdown, a very shallow recession as opposed to a deep recession. So I'm pretty sanguine about the outlook right now. Okay, time to talk about the election. 2024 was really, any questions, Julian, before we move into politics, or should we jump right in?
I think it's a good time to talk about the election and then move on to the last section on positioning portfolios, and there'll be a lot of questions on specific asset classes.
Got it. Okay, we're an hour in already, which I hadn't anticipated. I was joking with Julian at the top that we might actually not get to 90 minutes, but we always do. So 2024 is the year of the election. Half of the world's population was subject to a democratic election, however you describe that. I mean, Russia was one of those countries. So, but you had an election in Taiwan, South Korea, Japan, India, EU, UK actually had their election. This was they had a snap election and changed government, and the US. And in France, there was a change. There was a snap election called by the president of France, and they've now got no government yet, but they'll have a leftist government. So even strong and popular governments like Narendra Modi in India underperformed. His party won. He remains the leader of the party in the country in India, but a lot of folks have gotten voted out. It's been very anti-incumbent, and that is to be expected. The most important thing when thinking about who's going to win the election is what's the price of food and gas, and do I have a job? And that's why the Democrats are hoping that the unemployment rate just ticks up slowly or stays where it is for the next 3 months, and that gas prices and food prices continue to come down. But even if they do, there's a chart I want to show you that shows that while the momentum on inflation and the year-over-year numbers are looking very good, it's the overall level of things that have been up 20% in the last 4 years and 30%, almost 30% in the last 8 years. Things cost 30% more than they did 8 years ago on average, looking at the CPI. And that's what people remember. And when people think that the government is responsible for inflation, which to some extent it is, not a great extent, but some extent, the policies pursued do have an influence on inflation. And certainly the COVID response is generally to blame for the inflation, not necessarily the Fed, but the COVID response is so unusual and needed to be, so massive, and you can't fine tune the U.S. economy. So, and so the administration rightfully gets blamed to a certain extent for inflation. So what's going to happen in this election? We're not going to know who the winner is on November 6th. So the election is November 5th. You got 60% of the population is going to vote absentee or mail in. So they're going to get counted. It's going to take 3 days to get a lot of that counted, unless there's a landslide, which there won't be. So December 17th is the big day. That's the day that the states have to certify the Electoral College winner. So between November 5th and December 17th is overtime. By January 6th, the Congress will meet to declare the results and to read the results. That's the only thing Congress can do, is read the results of the Electoral College votes that have been certified and sent to Congress for review. And then on the 20th, the new president will be sworn in. But you're likely to see the same thing we saw in 2020, and the same thing we've seen in most elections where mail-in and absentee voting is allowed. You see an apparent Republican victory on the day, then all the mail-in votes are counted, and then you get a blue shift. So be prepared for a blue shift. That's what we got in 2020. It's deja vu all over again, and it's likely to be contentious. And in fact, if you don't get a landslide, then things are going to trade differently. If you get a landslide, a blue sweep or a red sweep, or a huge, presidential victory for blue or red, then risk markets are just going to trade on policies. But if it's too close to call, then you're going to have to deal with the contentious and volatile aftermath, where you're going to have a battle that is waged not only in the court system, but also in the court of public opinion. And then risk markets will trade more volatilely. And the reason that we're going to have all of this is because we're so divided. So this is a chart, I might have used this last time, how polarized we are. This goes back to the 1880s, and it measures the moderates in the House and the moderates in the Senate. During the war years, from 39 to 57, plus or minus, about half of the members of Congress, either the House, which is the gray line, or the Senate, which is the orange line, considered themselves moderate. Prior to that, 10 to 20%. Now we're back down to 10 to 20% again. And this is how do you feel about the other guy? So back when Eisenhower was running for president in 54, 58, you had against Adlai Stevenson. If you didn't like Adlai Stevenson, or you weren't going to vote for him, at least he had a 48% favorable rating. That is, the other guy, where Eisenhower within his party had a approval rating of almost 90%. The other guy had an approval rating, at least it was, reasonable, 48%. Nobody has approval ratings like that. But now, if you're looking at, you know, the other guy is just, you know, kind of despised, which is this is terrible in my opinion. It's not the other guy isn't horrible, whoever your guy is or gal in this case. So just be, you know, the polarization is high, and it's been higher than it's been since the Civil War, and it's bad for democracy. So here is the Electoral College map, by the way. It's not a popularity contest. Remember, it's not who, you know, if you ask people across the country who's going to win the election, it doesn't matter. It's who's going to win, probably Pennsylvania and maybe Georgia. Right now, at least at the end of July, before the most recent polls, Georgia had gone from toss-up to lean red. But it's gone now back to, in fact, it's gone back to toss-up. And this is as of August 8th. So in the last week or so, things have shifted in Electoral College math. So again, it's all coming down to Pennsylvania, Michigan, Wisconsin, Georgia. And in fact, there's only a couple of pathways for the Democrats to win based on that map to get to 270 or 271 or 272. Everything goes through Pennsylvania, whereas there's 5 winning combinations for the Republicans. There's only 3 for the Democrats, and PA is in every single one of them. So if the Dems lose Pennsylvania or the Republicans win Pennsylvania, it's probably game over for Team Blue. Oh, I'll just highlight the fact that 2 weeks ago, I said with a great deal of assurance that Josh Shapiro would be the vice president on the Harris ticket. This is as of July 30th because of Pennsylvania, but I was wrong. Not the first time. Presidential election changing Electoral College vote map. Just California is losing Electoral College representation. Texas is gaining. 2 of the toss-ups, by the way, Pennsylvania and Michigan, both lost an Electoral College vote from 2020 until 2024. So this is a big move from the, you know, Rust Belt to the Sun Belt. You've got Florida picking up one, Texas, which is both of these are lean or solid Republican, and they're picking up votes. Where Oregon, blue, Colorado, Illinois lost one, New York lost one, Colorado and Oregon picked up one. Harris has got a bit of a honeymoon going. This is as of a week and a half ago. Her unfavorability, positive is unfavorable. Her unfavorability rating improved. Kind of a funny way to say you're more popular. Your unfavorability rating improved by 10%. And post the assassination attempt on Donald Trump, his party is also his base is coalescing around him, and his unfavorability rating also improved. Just improved more. There's a lot more. It seems to be a lot more energy and excitement around the Harris campaign right now. That's a honeymoon potentially. Probably will fade after the Democratic National Convention coming up next week here in Chicago, starting on the 19th. So we'll see. You also need to see more from, I think, both candidates on their policy priorities. We'll talk a little bit more about that, but let's see who's going to win. Right now, I mean, if you looked at the Biden keys to victory, and this is, by the way, Professor Alan Lichtman, he's from American University in DC. He's correctly predicted, based on my assessment, 10 out of 10, and based on the actual results, 9 out of 10 of the last elections, he picked Al Gore to beat Bush. If the Democrats get all of these, you know, keys, these are the 13 keys. It's pretty popular analysis way to analyze the election. And again, it's worked in the last 40 years, 9 out of 10 times. So do you just take a look at these 13 keys? We'll have this posted, but know if you get 6 or 7 of them, you're 6, 7, or 8 of them, you're gonna win the election. And as it stands right now, it looks like whether you're looking at Biden or Harris, she lost one of these keys. One of the keys to winning the election is being the incumbent. The incumbent has a pretty significant advantage, but that moved from Dem to Republican because she's not the incumbent. But that still leaves the Republicans some work to do on some of these other areas. The only one that could change radically is the short-term economy, or if Kennedy somehow catches fire and you get a third-party candidate. But there was no serious contender for the nomination. There's been no social unrest. There's been no significant scandal. And so what you've got here is, you know, an analysis that suggests that Kamala Harris is likely to win the election today. We're 85 or 86 days away from the election. By the way, that's a long time. In Japan, the election period is 12 days by law. In Mexico, it's 53 days by law. In the UK, you can announce an election for a new government, and in France, and 3 weeks later, you have the election. 85 days is a long time. It seems very short because our average is like 350 days from the time, or 360 days from the time the first candidate announces. It's kind of a ridiculously long period of time, but here we go. So here's predicted. I look at predicted, I look at 270 to win, I look at real clear politics when I'm thinking about kind of who's going to try to think about who might win the election, but it's really about policy. So the predicted markets basically say that it looks like Harris is going to win, but it's not a popularity contest. I'll go back to the Electoral College and say, just if you know who's going to win the blue wall, which is Pennsylvania, Michigan, and Wisconsin, if you pick those three states, you've got the election. And right now in Michigan, Pennsylvania, and Wisconsin, these are the most recent polls, 83 days. There's 83 days to the election, which is a lifetime. It's got Harris. This is what was surprising about the New York Times Siena College poll, which was released on Saturday, is that every state is 50 to 46. That seems unusual. I'm going to highlight this, and it's something you should expect to see more between now and November 5th. Each one of the candidates or their vice presidents co-opting the other's policy priorities. So the policy agenda items for the next 83 days, I mean, you're going to hear a lot about the higher minimum wage. The Republican candidate actually, or J.D. Vance actually put forth a higher minimum wage, expanded child tax credit, and no taxes on tips for, I mean, all of these things are kind of looking for, both candidates are doing it. It's really funny. The policy priorities put forth by the Republicans, it's not really, there's not a high incentive for Kamala Harris at this point to put more meat on the bones for her economic policy. She was announced about an hour and a half ago. She's going to put forth an economic plan between now and Friday. So we'll see how that goes. And as a result, I mean, it's going to be, I don't know. So far, the battleground state polling numbers are looking good for Harris. But here's what's going to kind of drive it. I'm going to go to the next chart and finish up on elections by looking at this one instead. Tells the same story. Here's the CPI headline, year over year numbers versus the Fed's target as of a month ago. So the momentum is good. The year over year numbers look good. But this chart shows what the inflation rate was during the 4 years of the Trump administration and in the 3.5 years of the Biden administration. During Trump's administration, inflation was up cumulatively almost 8%, but it was up almost 21% during the Biden administration. And that's what folks are focusing on. They're not focusing on the positive developments on the year over year. They're focusing on the fact that everything costs 20% more than when Biden took office at the beginning of 2021. So momentum is good, but it's this overall price level change that's going to be challenging. And whether or not Kamala Harris can distance herself from the policies that led to this is the key. A couple more quick slides, and then we'll wrap it up. Here are the inflation rates in Wisconsin, Pennsylvania, Michigan, and Georgia. And in each case but Georgia, the state inflation rate is less than the U.S. average. So this difference here, Wisconsin, Pennsylvania, and Michigan's probably something interesting to note, that inflation, while high, has been less in those states. And with that, I'm just going to highlight the fact that once again, looking at the RCP, or Real Clear Politics, the Electoral College map, these are with the toss-up. So nothing's determinative here. But based on the RCP polling, if you just basically gave every state based on their polls to the candidates, you'd have a Republican victory over the Democrats. And it's all comes down again to Pennsylvania. So I want to make just a couple of quick comments on government control, because that's the most important thing. This is the Senate outlook. The Senate is tipped to go red. There's more Republicans, or there's more Democrats that are up for re-election this cycle than there are Republicans, and the voting, the polling seems to be tipping to something on the order of 50 Republican, 48 with 2 toss-ups, but it's likely to go red. So and the House is actually tipped to go back to the Democrats. So you're not likely to have a unified government. Having said that, that's probably the only outcome that matters to investors, is a blue sweep or a red sweep. And a red sweep was forecasted 3 weeks ago. That was getting better than a 50% with some pundits. There's now talk of a potential for a blue sweep, which both of those outcomes seem exceedingly unlikely. But it doesn't, the only thing that matters is what can you get legislated? What are the policy priorities that are going to be talked about during the campaign aren't what can be legislated. So we can talk about that in a sec. Julian, is there a question?
Yeah, I think you pretty much answered all the questions we had on politics. And I guess the one I was going to ask about, if we can talk about policies, and actually you just put the slide. So what are the different policies depending on who's going to win that election, right, and how should we think about their impact on the market?
These are the biggest areas of interest: trade, Fed, taxes, regulation, and immigration. And I think we all pretty much understand what the candidates have said about each of these main areas. The implications are first, I think, on growth and inflation, because policies, again, matter for growth and inflation. So it's good to know, or make some judgment about what the impact would be. In terms of trade policy, tariffs are by definition makes goods in the U.S. cost more. Any tariff that's put on a good that's imported into the United States gets tacked onto the price of the good. Tariffs are inflationary, whereas I think Harris would continue to engage in China and beyond. There's not talk of the types of or the magnitude of the tariffs that the Trump administration will put on. In terms of Federal Reserve policy, if you reduce the Fed's independence, the markets will riot. And I think it's unlikely that either candidate would actually go so far as to reduce the Fed's independence. But Harris basically yesterday said there's not a chance she would. That is very positive for market participants. In terms of taxes, you're probably going to get higher growth. Same with regulation. The regulatory environment, if you slash regulation and keep taxes low, you're likely to that's likely to produce higher growth. But we're at near full employment right now, so a growth boost now is likely to be slightly inflationary, whereas Harris would push for higher taxes on the wealthy and corporations. That's likely to reduce growth, which would hence be disinflationary. And in terms of immigration, there's really no controversy about this. If you shut off the supply of low-wage workers that are willing to take jobs here in the United States, you reduce the labor supply. Common sense economics dictates that the price of labor will go up, hence wages will go up, hence inflation will go up. So most of the types of policies that the Trump administration are promoting are likely to be higher growth and hence higher inflation, whereas it's the kind of the opposite for the Harris-Walz team. Here's, again, the most important thing. If you get a red sweep, then you can actually think about legislating some of this stuff. But does the president matter? I don't know, but the president plus Congress matters more. So if you get a red sweep, you'll see a positive response in risk assets and financial and inflation protection in financials because of a lower regulatory environment. Whereas if you get a blue sweep, you're likely to see a positive response in things like renewables, infrastructure, and U.S. interest rates. And these are the negatives. These are almost exactly the opposite. So it does matter. The sweep is what matters, but not totally. And there's one more slide on the president, and does it really matter? And the answer is, does the government matter? I mean, going back to 1933, it didn't matter if you Democrat or Republican was in the White House, stocks went up. That's the most important thing to take away. And whether it was a unified government or unified Congress with a president of another party or a split Congress, doesn't matter. Stocks go up. These are the average returns on the S&P 500 going back to the 1930s based on these various forms of government. So again, you could split hairs and say, a unified government's best. I don't think it is. That seems unusual to me. Because there's no way to say the policies of this particular Congress, which were implemented during this 4-year period or this 2-year period, they have implications for the economy that go well beyond the days that those folks are in office. Same with the president. The president doesn't have that much influence on the U.S. economy. And in fact, the only thing you should think about is this. It's the behavioral issues related to an election year. In an election year, equity mutual funds tend to see very low inflows, whereas money market funds see massive inflows. Over the last 30 years, during an election year, more funds flow into money markets than into equity funds. And then the next year, funds go from money markets out and into equity funds. So this investor behavior of being uncertain and going into cash doesn't make any sense. There's other things that matter a lot more, and that's what we should be thinking about. So my final thoughts on the politics are this. These elections may matter to investors, but they don't as much as you think. You have to be aware of the policy priorities and what can be legislated, not just what's being talked about on the campaign trail. None of that gets legislated because unless you have government control, full government control, and when I say full, I'll tell you what I mean by that in a second. Even government control is misleading. You need 60 votes in the Senate. Campaign promises do not equal what can be legislated because you need 60 votes in the Senate. So the economy, inflation, and the Federal Reserve, which is what we started with at the beginning of the presentation, along with corporate profits, these are the things that matter for asset prices. And some of the policy priorities that get talked about on the campaign trail may have some influence, but only if you can get 60 votes in the Senate. And no party is going to get 60 votes in the Senate. So you can safely discount much of what's going to be said between now and November 5th because it's not implementable. And that's where I'll leave it for politics and policies. Julian?
Yeah, we have another 10 minutes or so. And just to preview the final section on the portfolio positioning. So in light of the recent market volatility, how should you basically build your portfolio or adjust your portfolio?
You shouldn't. You should know that the portfolios are built to withstand what is normalized volatility. There's nothing unusual about what's happened in the last, couple of weeks. It was unusual in 2020, for sure, because we had not seen a pandemic. But ultimately, the markets, righted themselves and recovered very nicely and then some. So the way to think about investing during periods of higher volatility is to just ask a couple of questions about what's my financial goal and does my advisor or consultant use the proper tools to build a portfolio that should achieve the goals regardless of the short-term volatility in capital markets? And the answer is we do. Not everybody does. Not everybody specifically ties the financial plan or the IPS statement explicitly to the portfolio construction process by reducing the tracking error volatility of the portfolios. So know this. There's a lot of portfolios that you could build that would be a 70-30 portfolio, but there's only a very few that are first, and Stephen Marshall is going to love that I mentioned the efficient frontier, that are on the efficient frontier. That means they're optimized. That is, there's no other portfolio that you could build that would achieve higher returns for the same level of risk or the same amount of return for a lower level of risk. So first thing you do is get the portfolio on the efficient frontier. The second thing you do is make sure that the portfolio overall, you use state-of-the-art risk modeling tools. State-of-the-art risk models will tell you how much the portfolio's performance will deviate from the assumptions in your investment policy statement or in your financial plan. And if you build a portfolio that's a 70-30 that has a high level of dispersion, you cannot be confident that you will achieve your objectives. So the key is having a bunch of investors that have been doing this for decades, using state-of-the-art risk modeling tools at the helm of your investments team, providing inputs and direction to the private client and the institutional portfolios equally. Every portfolio we built for a private client on the strategy, if you're on a strategy portfolio, a risk managed tactical portfolio here at Beacon Pointe, your portfolio looks just like an institutional portfolio. And we just think that's the way to get through the short-term volatility, is to have a low tracking error, have a long-term investment horizon, and know that the portfolio is built to weather these types of periods. Julian.
Yeah, I'm going to use the last 5 minutes to answer some questions on some asset classes. So one specifically about fixed income. Is that a good time to buy muni bonds? And what's our view on private credit?
Muni bonds, yes, because real yields are high. Bonds can provide the required ballast and hedging to the risk asset in your portfolio, not like 2022. What happened in 2022 was you started with interest rates very low, but interest rates are quite high and real yields are very high right now. So yes, municipal bonds in an appropriate, 70-30, 60-40, whatever the weighting is, you should have municipal bonds for ballast and for income, for sure. Now's a good time. We like bonds. Private credit, most favored alternative asset class right now and has been for 4 years. The outlook for private credit is still good. The outlook for most alternative investments is very good over the next 3 to 5 years. Real estate actually looks pretty good right now. Things are getting priced at a level where new investment is going to do very well in the next 3 to 5 years, as long as the Federal Reserve starts cutting rates and takes a little pressure off the real estate market. But private credit gets a lot of bad press, and some of it may be deserved, but there's a way to mitigate your credit risk by hiring only the managers that are focused on the upper end of the capital structure and senior debt, diversified portfolios, lower leverage, safety first when it comes to credit. Don't be a hero with private credit or any kind of credit. Your risk assets are equity like securities. Private credit is there for income and for ballast as well. Julian.
Yeah, just another one on gold specifically is gold is outperforming every major US indices, pretty much every asset classes this year. So what's our outlook for gold and where does it fit in a portfolio?
It doesn't necessarily fit. Gold's out doing well because the expectations for interest rates are declining. Doesn't have any income, so gold tends to do well when interest rates fall, or when the expectation is that interest rates will fall. That and during geopolitical crises, and there is enough to be concerned about, globally. But when these things get resolved, gold will likely stabilize. Yeah, I mean, there are periods of time you could pick when gold significantly outperforms. There are periods of time when you could pick bonds significantly outperform. Gold is not a strategic part of our asset allocation. I think it's a hedge. It's not a significant component of any institutional portfolio. Commodities, yes. Real assets in the form of tips or infrastructure, yes. Specifically, precious metals, generally, no. It's a private client asset. Typically, it appeals to private clients because of its ability to hold its value during negative drawdowns, but it doesn't keep up on the upside. So in the long run, we won't see or have a strategic allocation to gold. Having said that, we have had tactical allocations in the past, but not this year.
One question in talking about equities, about sectors. So what sectors do you think would be the most affected by a recession, and how would you position an equity side of a portfolio for a recession?
It's already positioned for a recession, and we don't make sector bets. We do make allocations based on growth versus value. So technically, we're moving around sectors when we overweight or underweight value versus growth. But we look at factors and we look at indices broadly. Trying to pick the right sector weights is very challenging because the sectors are pretty heterogeneous. But in a recession, the more cyclical sectors and growthy and momentum type sectors are likely to do poorly. So tech and communication services, and maybe to a lesser extent, consumer discretionary would likely get hit. And the more defensive sectors, which historically have been utilities and maybe real estate, would probably do anything that throws off a little more income during a recession will protect you to the downside. But again, we're not making sector bets in our equity allocations. We're looking at the relative valuations between large and small, growth and value, U.S., non-U.S., and making our judgments to tilt the portfolio into various aspects based on that. And just to summarize this chart, we still like large cap value. In a recession, large cap value might do better than growth this time. It might. We would think it would because of the valuation differentials. Value looks really cheap compared to growth, even after the 3 weeks from July 14th. Large caps look okay versus mid and small in a recession. Small caps generally get whacked pretty hard in a recession. So we like large over mid and small, and we like US over international now, slightly, very slightly, based on our outlook for the dollar and the fact that the US economy is more resilient than other global economies. And there's just nothing. Yeah, sorry, go ahead, Julian.
One final question, I guess. What keeps you up at night? An international conflict, a new virus? What's the black swan that you cannot predict?
You just answered the question. I mean, a black swan is defined as something that was completely unexpected that had a major impact on the market. So there is no hedging or forecasting, and hence why worry about a black swan? I don't worry about anything, really, because I know the portfolios are well positioned to achieve longer-term investment objectives, even with short-term volatility or even with a short-term negative drawdown. I mean, we saw that in 2020, we saw it in 2022. Short-term volatility, short-term negative drawdowns are inevitable. A recession is inevitable. For 50% of the time in the last 100 years, we were 2 years away from a recession, no matter what day you picked. So we're going to have a recession. It's coming. We're going to have a minus 25% on the equity market. It's coming. I don't know when, and I don't care, because I know the portfolios are well diversified and they're built to withstand the inevitable volatility. You don't get paid to hold cash, which is a zero volatility asset. You only get paid to hold volatile assets. And as a result, I always say volatility is the price you pay to build wealth. So let it happen. Bring it on, I say, because the portfolios are diversified. They're well constructed. They're risk managed, and they'll get you to where you want to go. And with that, I think we should probably close it up. Julian?
Yeah, thank you, Michael. That's a great way to conclude this webinar. So please, everyone, look out for our invitation in your emailing boxes for the next quarterly macro and market update that will take place on December 12th. See you all next time. À bientôt.
Thank you very much for joining, everyone. See you very soon. Take care. Bye now.